Well, so right now, both polling and betting markets are suggesting that Republicans are going to win one or both houses of Congress, and so we would enter a more split government. In some ways, it's already been split. I mean, the Senate in particular has been, especially the way that it works, where when we have a filibuster, for example, there's limitations on what you can get through anyway. So we've already had a somewhat split government. It's going to, I think, get more split going forward. And so I think a lot of people assume that that kind of locks in, that it means no new spending. And I think that could be true, but it also means no new taxes probably, or very, very challenging to raise taxes, right? So when you look out long term in the United States, we've got structural trillion-dollar deficits as far as the eye can see. And then with the increased interest rates over time, as that some of that debt comes due and gets reissued, basically as that debt rolls over, it starts going up in terms of interest payments by the federal government, and that actually increases the deficit even more. And so as we kind of look out, and that assumes no recessions, right? That assumes no recession in 2023 or 2024, even though, for example, the yield curve is currently inverted. We have kind of a slowing, a decelerating economy. And so even assuming no recession, it is very, very large deficits. And that's generally this type of more inflationary type of environment where you have a deficit that you can't fully control. You can't really raise taxes politically. You can't really cut some of these programs that are very politically popular. It'd be very unpopular to cut them. I think a lot of that kind of forward spending is already locked in, uh, and so I think that in some ways gridlock just reinforces that further. Well, so they were kind of hinting that they might start initiating language about still hiking, but at a slower pace. And I think that's probably on the table now. We did get a decent job report, a job opening report, and also we've had some Fed officials kind of walk back some of those dovish things and kind of reiterate a hawkish view. So maybe they go another meeting before they introduce that type of language. I think there's kind of a toss up there, but I think that with rates where they are and kind of the state of the economy, I do think that we're probably getting to a period where they're going to that the rate of change, the hawkishness and rate of change terms is probably peaking, even though in absolute terms they're obviously not at the rate that they want to get to and that the market's pricing for. So I think that that's going to be something to keep an eye on. And I think a longer term dynamic is really just to focus on the energy market because the U.S. is drawing down its strategic petroleum reserve. I think somewhat past the midterms, that's probably going to stop, or they could keep pushing it further. But there's obviously there's only so far they can draw that down. At the same time, China is still under kind of these rolling lockdowns, which reduces flights, it reduces just various types of fuel use, um, and as Europe kind of continues to go through a natural gas shortage, and right now, for example, there's unseasonably warm weather. They got the storage tanks full, but over time, but there's also demand destruction. A lot, like as we talked about, a lot of plants are closed, right? So as you want to kind of move forward and reopen, there's still a lot of energy demand, and there can be substitutions, right? So you can have more coal, you can have more oil usage, for example, and I think that the market is too kind of calm about what could happen with oil over, say, a 5-year period, right? If you look at a lot of analyst expectations when they, Wall Street analysts, when they look at, say, an oil company and they kind of price out what's going to happen, they usually assume like 60 or $70 oil. They kind of assume that the spike's just going to go back down and we're going to kind of go to this like, kind of low plateau. Obviously, different shops have different price estimates, but for example, if you look at Morningstar analysts, they're using $60 oil for their long-term assumption, and that I don't think that's a world we're going back to. I mean, you could maybe hit those types of numbers briefly if you have a sharp enough recession and period of demand destruction. But when you look at the supply side, I think that's still going to be an inflationary variable. During COVID, there was a big shift in terms of kind of overnight people's demand shifted, and that put a lot of stress on certain aspects of the supply chain, and that's coming off, right? That extreme level of shift is kind of behind us. But I think that the second story here is the ongoing energy markets, and I think that essentially what happened with natural gas in Europe kind of happened with oil over like a multi-year period. And I think that that's a risk to be aware of, and that has all sorts of implications for bond pricing. That has implications for equities. That has implications for um, you know uh, gold, for example. And I think that's something to watch. And I think that one of the catalysts is that when the Strategic Petroleum Reserve stops going straight down, that's supply coming out of the market that's going to stop coming out of the market. Well, I mean, there's ways that they can try to cap it, but then the problem is, can they get it, right? So, kind of the history of price caps is that price caps lead to shortages, um, especially when you're trying to cap something outside of your jurisdiction. There's also been, if you're an energy producer and you're kind of a scapegoat now for various politicians that are dealing with inflation, and they say, well, it's the energy company's fault, right? I mean, if you look at most, long-term charts, energy companies have been terrible investments for like a 15-year period. They've generally not done very well, and it's not like no, when they were not making money and they were going through bankruptcies, no politician wanted to, save them. But now that they're actually having a profit, there's suddenly like these, people are floating windfall taxes, they're floating nationalization. Obviously, different jurisdictions are handling that differently. And if you're an oil company, you're looking at this environment, you say, okay, well, we don't know what oil pricing is going to look like over the next several years. And we also don't know what percentage of our profits we're even going to get to keep. I mean, essentially, we have all the downside if oil has a bearish scenario, and we could have our upside capped in some way. And so that certainly is not an attractive environment to put billions of dollars into long-term projects. I mean, you can do short-term shale type of work, but if you're going to go offshore, you're going to do some sort of like large investment project. It's not a very attractive environment for that to happen. And I think that so many people look at the demand side of energy, and I think that supply side is going to continue to be pretty tight going forward. And you know, that's only one of the variables. There's also just it takes a long kind of investment cycle to bring more oil online, and I just think that we're still like nowhere near kind of starting that in earnest. Well, I mean, it's a more volatile metal than gold. I think they generally, more often than not, they go in the same general direction. And so if you were to have, a bullish move in gold, I think that silver would likely follow, and probably with greater amplitude. Um, I think you have to be more careful with position sizing when it comes to silver, just because of the volatility. It's also got that long-term usage in a variety of technologies. And so it's that hybrid metal between, it's got a monetary premium, but it's more used in industry. Um, and so I'm constructive on gold, silver, and platinum really. I think, and same thing for copper, for example, when you look out long term. I've been cautious about copper in this kind of decelerating economic environment, but when I look out long term, I'm quite bullish on copper. So I think that the kind of the broad commodity spectrum, whether it's gold, silver, platinum, copper, oil, on different time frames, I think are all pretty attractive. I think we're at the early innings of a commodity decade. That'd be my base case. Now I continue to reassess that as new data comes in, but my kind of base case for a while, for a number of years now, and still going forward, is that I think this is like a broadly constructive decade for